you. There is a heightened recession risk because I travel around my part of America and I talk to businesses large and small. The most common comment that I get is that they are uncertain about the outlook. So they're nervous about making new investment decisions. Even businesses have said to me, if they knew where the tariffs would ultimately settle, then they could adjust their supply chains around that new environment. All else being equal, they may want lower tariffs, but wherever they settle, they could adjust to that. But right now, there's still so much uncertainty as the negotiations are continuing. A lot of businesses are on hold. And if businesses and consumers are on hold, that introduces downside risk for the economy, potentially even recession risk.
Naturally. I mean, one of the other things that naturally we've been focusing on is what kind of inflationary impact, what kind of jobs market impact these tariffs might have. And yet so far, there hasn't been a huge impact, at least noticeably, in either the jobs or inflation data. Does that give you some kind of sense that maybe those effects may not be coming, or do you have confidence that they will come in coming months?
It's hard to imagine them not coming. So first of all, on the job market front, you're right. The U.S. job market is held remarkably firm. New claims for unemployment insurance have not materially climbed. That's good news. But businesses that I talk to have said they're on hold, and they're actually running scenario plans that if the tariff uncertainty persists for a lot longer, then they might have to start shedding workers. Coming out of the pandemic, it was so hard for businesses to find the workers that they needed. They're very reluctant to let them go because they might not be able to find them again. And so they're moving very slowly. On the prices front, you're also right. We haven't seen yet a big imprint on prices. We also haven't seen any shortages. You know, when I go to the local stores in America, a lot of the goods are sourced from abroad or sourced from Asia. The shelves are still full. So we're not seeing, the American people are not yet feeling the impact. And hopefully there will be quick resolutions to these trade negotiations, and then there will not be a long-lasting effect on the economy overall.
Mm-hmm. If we do start to see, however, a push upwards on inflation in coming months, Neel, you mentioned that you're worried about consumers and consumer confidence. Which would the Fed then want to focus on if there was, you know, a weakening consumer, a weakening economy, but inflation was also starting to creep back up?
Well, this is the debate that we're all having, and my good friend Austin Goolsbee, who you just played a clip from, I think articulated it very clearly. For me, because inflation in the U.S. and around most countries in the world, most advanced economies, because inflation has been elevated for 4 years, I am very nervous that eventually inflation expectations may lose their anchor to that 2% target that we have. If inflation had been running at 2% or below for the last 4 years, I would be more comfortable, quote unquote, looking through this one-time tariff-induced inflation. But because inflation has been running hot for 4 years, that makes me nervous, and that makes me want to err toward protecting and defending the inflation anchor of 2% and not looking through the higher inflation.
And Neel, so I guess what you're saying is that Trump tariffs have raised the bar for rate cuts at the moment. But do you think the recent bond market behavior could change that for the Fed?
You know, the bond market moves around. The long end of the bond market, for example, moves around for a lot of different reasons. Part of it is expectations for the path of monetary policy. Part of it is what do investors think about inflation? That's our job to control that. And then part of it is how much do they want compensation to fund the government? And so the last piece of that is not in our control. That really is up to the Treasury and the Congress and investor preferences all around the world. And so we have to focus on our job, and that is to keep inflation and inflation expectations anchored. And I'm confident we're going to do that. Whatever the government decides to do in terms of taxes and spending, that will be an input into the economy and our analysis, but we know what our jobs are, and that's what we're going to focus on.
What's the conversation at the Fed on the why? I know that you laid out multiple potential reasons, and it could be really all of the above, but many are saying that this is something structural about it, perhaps a structural source of demand for U.S. Treasuries, especially on the longer end of the curve, is drying up.
Well, you know, it goes back to, I've been saying this publicly for a while now. We have to start with, why does the U.S. have a structural trade deficit? The flip side of the coin of having a trade deficit is that the U.S. is a place where investors around the world have wanted to invest. So we're a destination of choice for investment capital. And then the flip side of that is you will then have a trade deficit. And so for one to eliminate the trade deficit, we would have to no longer attract the investment flows from around the world. Now, there are a lot of reasons why bond markets could be moving, but ultimately, if the U.S. trade deficit is going to be lower, there on the marginal, less investment capital would be flowing into the U.S., and you would see that in terms of higher rates across the curve.